Is now a good time to invest in the S&P 500?
There's a lot of bets right now that we're actually going to see record highs for the S&P next year.
After a volatile 2023, the index is edging closer to all-time highs, but several warning signs are flashing red.
I continue to see a challenging macro picture heading forward.
In this video, I'm going to run through the pros and cons of investing in the S&P 500, and stick around till the end where I'll suggest some alternative markets for you to consider. Let's get into it. Warren Buffett is famous for saying that the average person only needs to invest in the S&P 500. But is that really true right now when the risks seem to be skewed to the downside? So last year, the S&P 500 suffered one of its biggest falls in the last 20 years, losing 19%. But this year, despite some volatility, it's nearing all-time highs again. After a roaring first 6 months of the year, in the period from July to October, the S&P 500 officially entered correction territory, losing 10% from the peak to trough. But then in the last month, frenzied trading has seen the S&P 500 reach near all-time highs again, and it's now up a stonking 19% year to date. It's left a lot of investors thinking, make your mind up, S&P 500. As of last Friday, 24th of November, US stocks were the best performing major asset class so far in 2023, significantly outperforming European stocks, gold, and fixed income and bond markets, according to BlackRock, the investment manager. This is remarkable given that it's happened at a time when interest rates have risen so dramatically. When interest rates rise, stocks are supposed to underperform because bonds have become more attractive. Higher rates make borrowing for companies more expensive, which means they have less money to invest back into the company and less cash flow stability, which typically puts pressure on share prices of stocks. So why have US stocks, and specifically the S&P 500, been doing so well this year? Well, Julius Baer, the Swiss wealth management firm, offered this explanation in a recent client newsletter. It said that the higher rate environment counterintuitively has led to a positive impact on overall S&P 500 earnings. The technology heavyweights of the S&P 500, the Apples and the Microsofts of this world, they used the early days of the pandemic to lock in ultra-low interest rates with long maturity profiles on their outstanding debt. They basically bet that they could make more money hoarding their cash when they were borrowing at such low rates. This was a cunning plan, and frankly, they've been proven right. Given the sharp rise in global bond yields since the start of 2022, these companies now have the ability to reinvest their large cash positions at a more attractive yield, leading to a decline in something called net interest expense. In simple terms, this is just the interest you earn on your cash minus the interest you pay on your debts. Hence, these companies are not feeling the negative consequences of higher refinancing costs, and probably won't for the next few years, according to Julius Baer. This rosy picture for the largest companies contrasts starkly with that for the small cap companies, who remain vulnerable to the higher interest rate environment, given that 32% of their debt is floating rate or not fixed at low rates. This leads to higher refinancing costs, and as you can see from this chart from the Ned Davis Research Institute via the Financial Times, smaller companies are paying record interest expense without a major boost from interest income. So large cap companies like those in the S&P 500 have become more attractive relative to smaller cap companies. And this has played out in stock prices. The Russell 2000, an index of smaller cap companies in the US, is up only 3.24% year to date. And this contrasts starkly with the S&P 500, which is up 19.23%. There's also been positive sentiment following the third quarter earnings season. The S&P 500 reported year-over-year earnings growth of 4.1% according to FactSet, the data provider, and this outstrips analyst expectations, which were just minus 0.3%, so a significant outperformance. What a result! And another boost has been GDP growth, which came in at nearly 5%, for the third quarter. Extraordinary. Two themes really drove this: the US consumer continuing to spend, and government fiscal policy playing itself out with high government spending. As Robert Armstrong of the Financial Times said, GDP good, earnings good. Strong consumer plus big government equals hot economy. But the outlook for the S&P 500 is not without its risks. We shouldn't look at the S&P 500 through rose-tinted glasses, no matter how much we enjoy that famous Warren Buffett quote. Several firms, notably BlackRock again, have been cautioning against broad market exposures like the S&P 500 for many months now. You can check out my video on BlackRock's mid-year investment outlook in the link above, which goes into more detail on this. First, there's growing concentration of returns amongst the S&P 500, but what investment industry analysts are calling the Magnificent Seven. No, not that one. That's Apple, Amazon, Alphabet or Google, Meta, Microsoft, Nvidia, the chip maker, and Tesla. I think that's 7. I think I got that right.
Be good. You must be crazy.
According to Goldman Sachs, this group of 7 companies now accounts for 29% of the total market capitalization or value of the S&P 500. And this is an all-time high for the top 7 companies within the S&P 500. The Magnificent Seven have generated a return of 71% year to date, compared with just 6% for the remaining 493 companies within the S&P 500. Goldman's chief US equity strategist, Dave Costin, described the performance of the Magnificent Seven as a defining feature of the equity market in 2023. It's clear market sentiment is shifting, however, and this is backed up by recent research from the Michigan Consumer Sentiment Index, which has fallen for the last 4 consecutive months to 1st of November. And consumer sentiment is reading at much lower levels than it was 3 years ago, as you can see from this chart. Consumers are pretty gloomy, unsurprising when you think about the cost of living crisis and inflationary pressures felt across the West. Industry analysts have also been paring back their expectations recently. The latest S&P 500 earnings growth report from FactSet, the data provider, shows that despite Q3 earnings beating analyst expectations, industry analysts have significantly revised down their expectations for earnings growth next year. As you can see from the chart, the grey bars are September's results and the blue bars represent October's results. Downward revisions of future earnings growth expectations are rarely supportive of stock prices, and I wouldn't be surprised to see those expectations fall further. Achieving above 10% earnings growth year over year by Q2 seems ambitious to me, but let's see. And that strong consumer we talked about earlier, well, their cash savings are being depleted quite significantly according to Goldman Sachs, again via BlackRock. In short, there's a lot of data moving the wrong way at the moment. So in conclusion, how should we interpret these mixed messages from the S&P 500? Yes, Warren Buffett is famous for saying that the average person only needs to invest in the S&P 500. But he also said that it makes little sense for professional investors to only invest in the S&P 500. And a lot of portfolio managers are underweight US stocks right now. In BlackRock's latest investment commentary, they retain their tactical underweight to the broad US market, saying they don't think earnings expectations reflect the macro damage they expect, despite recognizing some short-term momentum. Going back to Buffett, it's important not to take that quote out of context too. Buffett's proclamations came during a 40-year bull run in bonds and a 15-year period where equities were supported by government quantitative easing programs or money printing following the global financial crisis. But those programs are being unwound now. So my takeaway is, what worked in the past really doesn't look like it's going to work moving forward. So therefore, I think it's wise to consider investment options other than the S&P 500, at least in the short term. Many investment managers are recognizing the value of UK stocks traded on the London Stock Exchange, which look relatively cheap compared to the S&P 500. Recent research by the London Stock Exchange Group shows that the UK is priced at a discount compared to other global markets. Emerging and frontier markets like India, Taiwan, Indonesia, and even Poland now come into view. Did you know that the Warsaw Stock Exchange Index is up 29% this year, outperforming the S&P 500 thanks to the election of Prime Minister Donald Tusk and its improved political and economic outlook? This shows that we shouldn't ignore other markets. So, is now a good time to invest in the S&P 500, or should we ditch it? I would say simply this: if you're making regular contributions to your investment account or your retirement savings and you're cost averaging over time, then it's probably still okay to keep investing in the S&P 500. As I said in my previous video on Vanguard's S&P 500 Index Fund and ETF, both of those products have outperformed Vanguard's LifeStrategy 100 Equities Fund on a 1, 3, 5, and 10-year basis. That track record is still hard to argue with. But right now, I certainly won't be increasing my investments personally in the S&P 500 beyond what I already hold in my diversified retirement savings. Whatever you decide to do with your money, I hope this video has helped you rethink your assumptions around the S&P 500. And if I've got you for a few more minutes, why don't you check out this video, which talks about the retirement savings crisis in the West, which I think impacts a lot of people and reveals the amount you need for a comfortable retirement. It really is a crucial video. Until next time, keep investing selectively and effectively.